Roxgold is a development and operating gold mining company. Our principal asset is the Yaramoko gold mine in Burkina Faso, which Roxgold discovered in 2011 and put it into production in 2016. So it's been in operation now for 3 years. It's a very profitable, very good operation. It's been a strong underpinning source of cash flow for our company. And we just made our first significant investment in terms of growth by buying the Séguéla gold project in Côte d'Ivoire from Australia's Newcrest Mining.
Tell us a little bit about Yaramoko, what you saw there, and perhaps what the restrictions were in terms of things like mine life.
I think for a company that's starting out and is a junior with a development asset, Yaramoko is exactly the sort of asset that you want to find. High grade, so extremely high grade, double-digit resource grade. We've been mining high grade now for 3 years. The interesting thing with respect to the mine life is that we published a feasibility study in 2014 which showed that we had a 7-year mine life at 100,000 ounces a year, so 700,000 ounces of production. We've been in production now for 3 years. We've produced over 350,000 ounces, and we still have a 7-year mine life with 830,000 ounces of resources.
So you're continuing to drill out and step out and work out how you can develop that body there. But you mentioned when we spoke last there were a couple of other targets you're looking at in and around Yaramoko.
Oh, absolutely.
How's that going?
Yeah, no, it's going well. So we've had a very active program of generating new targets, which we're setting up to start targeting and drilling in the second half of this year. I think as with a lot of projects, the brownfields potential is always the most compelling. If we can find another deposit like Bagassi South or the 55 zone, which are currently in operation, then the returns to our shareholders and the company should be very good. So that's motivating the search.
You hope to grow that and extend the mine life even further.
Yes.
So what are the things that you are looking at with your team on a daily basis? What's the things that are kind of keeping you awake at night in terms of needing to deliver?
Oh, really, continuing to deliver consistent production is the key for us. So if you look at our track record, we've tried to establish a record of under-promising and over-delivering.
It's enabled you to have enough cash to look at the second asset, which is Séguéla. Why don't you tell us a bit about what you saw there and why you've gone for that?
Sure. It really plays to, our real strategy, which is to offer per-share growth in both resources, reserves, production, but most importantly, earnings and cash flow. What I think happens with a lot of mining companies, and this is sometimes why I think investors may have a bit of a jaded view of the mining sector, is that the mining companies chase growth pretty much any costs, and a lot of that comes with issuing shares to acquire new development assets or new producing assets. And we think that it's very difficult to deliver long-term sustainable value in doing such a way, because if you're buying someone else's producing mine or you're buying someone else's development project, they've probably surfaced a lot of the potential value. We would like to do that ourselves. We believe we have a team and we have a good cash flow, so we'd like to take an asset maybe at an earlier stage, invest capital in it, invest the expertise, de-risk it, move it along, and ultimately make it more valuable.
So how do you do that? Because obviously no one sells good assets, right? Or if they do, they don't sell it cheap. There's a lot of crap out there too, right? So what are you looking for that says this is the one out of the 100 that we've looked at?
Yes, well, you're absolutely right. There is a lot of crap out there. We've popped the hood on a lot of assets, both operating and development and exploration assets, and to be honest, often not as advertised. And I think that's something that we're concerned about. With Séguéla, which is our first acquisition, I think it's a really good case study to understand how we look at opportunities and what we want to do. It came out of Newcrest. Newcrest is Australia's, as many people will know, Australia's largest gold producer. It's the third largest gold producer in the world.
So why they sell it to you?
So it probably looked like it didn't make their size threshold.
Right.
As I mentioned, the third largest gold company in the world. The asset now, we just published a new resource at nearly 550,000 ounces. So I guess they couldn't see visibility to the 5 million plus ounces that a company of that size needs to be able to justify the effort.
But you're not looking for that. You're not looking for world beaters, global scale assets. You're looking for a kind of mid-sized, profitable, low operating cost, high, reasonable AISC to this, and piecing together this picture. So tell us about the thinking. That's what investors want to understand. How do you think about these things, and why does that make sense, and how are you going to deliver it?
Sure. So I think we have the belief that little fish taste sweet. Yaramoko,
beautiful.
and we think it's not done, and we're finding more gold there, but it's not it's not a world-class scale asset, although very profitable. So we've taken that model and said, okay, we believe this is an interesting model. This is a way that we can operate in a competitive landscape and still add value on an appropriate risk and reward basis. So buying Seguela at just north of 500,000 ounces for $20 million of cash, and that's very important to us because we were able to pay cash that we generated at Yaramoko.
So no dilution.
No dilution.
And I know the share count has barely risen in the last 2 years, 2.5 years.
So we haven't issued shares in terms of a traditional equity financing since early 2015.
Yeah.
And we want to keep it that way. We want the owners of Roxgold to enjoy increasing share of resources and reserves and profitability and earnings and cash flow. So we believe today, as it currently stands, Seguela is an economic asset and will be the next gold mine that Yaramoko builds.
But the resource is 500,000, right?
Absolutely.
So is that... I mean, normally I wouldn't look at anything under $1 million. So what are you saying?
And to be honest, I think that's the sort of thinking that we're trying to take advantage of. We bought a project that we thought would be economic and we could make money off what we saw if it didn't get any bigger. Now,
Right. Okay.
550,000 ounces doesn't ring a lot of bells for people, but when you come from a company that our size, it's still a meaningful increase in production.
Would you have done that deal if you had to borrow the money?
Yes, I think so.
Share price took a bit of a hit because of some selling. Tell us about that.
Yeah, look, I think we've actually recovered a little bit.
You have.
In the recent last week or so.
But look, I want people to explain because if they look at the chart, they're going to go, "Oh, wait, there's something going on here." But it's explainable. So why don't you?
Absolutely. So it's been quite an eventful 12 months for Roxgold in terms of its share register. Probably a lot of your viewers would have seen this rippling through junior mining companies when M&G lost their Vanguard mandate in July of last year, and that went to Wellington. We're not looking to make excuses, but when you look at the share graph performance, basically from the day of that announcement, it trailed from $1.40 down to 70 cents or thereabouts as that overhang leaned on our stock, and that there's a bit of a subtle difference that's happened too because we historically have been a fairly thinly traded company. So we've got a good number of very long-term loyal shareholders who own big chunks of Roxgold and don't sell them and don't buy more, don't sell more. They're happy with their position. Yeah. So we've had limited trading.
Yeah.
And so when you have your second largest shareholder loses its mandate and everyone expects it to be sold, which it subsequently was, that's a bit of a problem for you. That cleared in late January, so there was a deal done and a block traded, which went to a lot of good homes, good long-term strong hands, and that really marks the share price has turned around quite a bit since then, and that's been very helpful for us. And what that's also done is it's really increased the velocity of our trading, so our share trading has gone up considerably. Yeah. And the upshot of that is interesting because one of the key sort of structural shifts in the junior resource market has really been the rise of passive investing. So we're well on track for inclusion in the junior ETF, the GDXJ, at the next rebalance.
That's a big deal. The GDXJ is a big deal
because you're looking at a significant new shareholder buying onto the register,
right? And
also that facilitates other shareholders, I think, who may be looking at being tied to the index, and then increasing our liquidity.
Great. Okay. Well, I hope that comes because I think for retail, family, office, and high net worth, that's a big deal. I'm looking at things like your ASIC and your overheads and your costs and your G&A and all of that sort of good stuff. And I always ask the CEOs in terms of what do they think juniors should be paying their board, their management, and how do they remunerate each other? Is it incentivized on deliverables, or is it actually I'll just take a big salary here? How do you guys look at that? How do you approach that?
So I think, and I mean, there's a lot of commentary on what's the appropriate
quite rightly
for shareholders.
Quite rightly,
I know it can be a hot button item for a lot of people. I think with Roxgold we have a combination of fixed and variable pay, and really it's fixed pay is a salary, and the rest is really to be put at risk. And there's two components to the risk-based salary. There's the short-term and long-term. Short-term is really set around delivering metrics. So for myself and for my team at Roxgold, we're incentivised on a variety of metrics. Safety is first and foremost. Production targets, making sure we hit various milestones in terms of development.
Who sets those?
That's set by the board.
So the board set the targets by which they're remunerated?
No, that's no. So the board don't have those sort of targets. This
Right.
is for the executive team.
And who watches the watchers, as it were?
The rise of the proxy advisor has been interesting in recent years. So I'm sure a lot of your viewers are aware, a lot of funds sort of are advised by proxy advisors, and these proxy advisors comb through the management circulars and annual reports to see what the pay mix is.
Yeah.
And they basically have a recommended approach. They have a template.
Without getting into there, we're going to get into development, etc. We will never sell. It's all of that stuff. Don't do that. Do the reality. What are the options for you if you build this out the way that you could?
Okay, sure. So the first and foremost is to try and make as many things as you can. Put them under your control as best you can. So there's a lot of variables that we can't control in our business, price of gold,
Absolutely.
whatever. But what we can control is our capital structure to a certain extent, and for us that's very important. And on the theme of why we went to Seguela, the beauty of this project is we can build this out without raising another dollar of equity. And that's, as I said, we paid cash because we didn't want to issue shares. From cash on our balance sheet and cash from Yaramoko, and probably a combination of a recut financing or project finance arrangement, we should be able to build Seguela without going to our shareholders and asking them to dip into their pocket to fund our growth.
Right.
Ideally, we would like to find a third project.
Yep.
And if we could rinse and repeat the Seguela style of experience, we would do that.
Yep.
Because I think we could then schedule that to come in after, say, Seguela.
Yeah.
And again, if we could do that, by minimising or avoiding dilution totally, and then use cash flow from Yaramoko and Seguela to then build that, we're actually starting to look like a real business as opposed to a mining company, because we're taking earnings, genuine cash flow, and reinvesting at an increasing return on investment.
That's what interests me. That's what interested me when we talked last online. The model was different. It seems to be a business which understands the needs of investors. So you're not asking them to continually fork out or diluting them. You're creating your cash to give you optionality, which is great. Are we going to see dividends at some point?
So an interesting thing, so a book that I've read, and I've read it a couple of times now, is Outliers. And maybe it's familiar. It really talks about CEOs have been very impactful, and tries to sort of divine what was different about these actors or these CEOs who really compounded earnings and made extreme returns for their shareholders. And one of those is really they don't typically pay dividends, they favour buybacks. So the form of return of capital to shareholders is buybacks.
Okay.
But what they do is they take the earnings from their business and they reinvest those earnings, allocate that capital into future growth.
How do they see a return? How are you going to get them that return to mean that, so they answer this question of, well, maybe I should have put my money somewhere else. So why stick with you?
Sure.
Why come into
So
Roxgold?
I think there's two paths. So in my career, generally the happiest path to realising returns has been to be taken out. And so I've been...
Well, is that true these days? Because the multiples are not what they once were. So what would you think they would be?
Well, I think that's because we're in a cyclical business. So for me, the biggest returns come from being able to work within the cycle. So it's classic. I mean, it's easier said than done. Buy low, sell high.
What do you think you need to create to put yourself in a position to, if you wanted, be taken out?
So my whiteboard has three operating projects on it.
Yeah.
And then a potentially world-class scale asset in the future.
Okay.
So we've taken our step towards getting two of those. So we've got our second mine.
Right.
So sequentially we'll build that. I would love to find another Seguela or something similar that's hiding in someone's portfolio that they...
But where's the bit where you're making investors money? Because spending money on stuff, great. So how does this three plus one world-class asset convert into a big payday for investors?
Well, I think so. I mean, I think compounding those earnings and making sure that if our share count has stayed tight, then those 374 million shares that we have on issue today are earning a lot more cash. Now, I think you get down to a debate, and maybe it's a bit more philosophical as to whether people want cash in their hands or whether they want to have that cash reinvested and continually grown at a higher and higher rate.
I'd say both, because it mitigates their exposure.
No, that's right. So I think so for us, we think as long as there are opportunities to continue to reinvest capital at sort of the returns we expect to see from Seguela and project number 3, we would recommend continuing to do that. I would like to ultimately have an asset that's in the pipeline that has the potential to be a real game changer, and that's probably taking some geological risk and investing in it, and moving along. That may seem a little ambitious, but from what I've seen in the past, when the market and the cycle is in your favour, then there's the opportunity to make an outsized return, and that's what we're sort of looking to do. So we don't know when or if that will happen again.
Yeah.
If history's any guide, it will happen. It's just hard to predict when. So what we're going to do in the meantime is build a company that will be irresistible, both to investors along the journey and also potentially a large acquirer in the future.